What will happen with interest rates? Right now, it's one of the biggest financial questions in Australia. Property investors are watching the Reserve Bank the same way farmers watch storm clouds rolling across the horizon. Waiting, predicting, wondering what comes next. Even though rates have stabilized somewhat, many Australians still feel like they are holding their breath, particularly investors managing multiple properties. One property can feel manageable, 3, 4, or 5 properties can start behaving more like a small business. Every rate movement matters. 0.25% might not sound like much on the news, but across multiple loans, that can mean thousands of dollars in a year in additional repayments. Suddenly, the portfolio that once felt like a well-oiled machine starts to sound more like a ute carrying too much weight uphill. The challenge is that many investors built portfolios during periods of ultra-low interest rates. Cheap money changed behavior. Borrowing power expanded, equity rose quickly, banks became more aggressive with their lending, people stretched further. Now the environment looks very different. The conversation has shifted from how fast can I grow to how sustainable is the structure if conditions change again. Strong property investing has never been about collecting houses like Monopoly cards. The investors who invest long-term usually focus on cash flow, buffers, loan structures, tax efficiency, asset protection, debt management, diversification, exit strategies. Interest rates are only one piece of a much larger puzzle. Sometimes the real risk is not the rates themselves, it's poor structure underneath the portfolio. A portfolio without buffers is a bit like driving across the Nullarbor with the fuel light already flashing. Everything feels fine until conditions change unexpectedly. The reality is nobody knows exactly what interest rates will do next. Markets speculate, economists debate. Headlines swing daily. What investors can control is preparation. Reviewing lending structures, stress testing repayments, reducing unnecessary financial drag, building cash reserves, understanding portfolio exposure. Making decisions based on long-term strategy rather than short-term panic. Property should probably support lifestyle and long-term wealth creation, not create constant financial pressure and sleepless nights every time the Reserve Bank meets. General information can help people understand the broader environment. Individual advice matters, particularly when managing multiple properties, complex lending structures, trusts, superannuation strategies, or family wealth planning. The goal is not simply owning more properties, it's building a portfolio that can handle changing seasons over time. If you are ready to make informed financial decisions, you're welcome to reach out to myself or my team. I'm Norma Falconer from thinkcapitaladvice.com.au.